Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts then. Komal of Finance.com, Savi Jain of 2.2 Capital, and Foram Parekh of Indiabulls Ventures join me on the show at this point of time. Thank you to all of my guests. Today on Hot Money, we'll discuss the rural or the agri theme, given the fact that, both the BJP and Congress have spoken about farm loan waivers. What's the best bet in the large cap and mid cap space since the markets have now started rallying? We'll talk about NBFCs because of late a lot of NBFC stocks have started rallying from the low. Is it a space that you should get into or should you avoid this space? And one stock they believe is overvalued or probably it's a stock that you should avoid at this point of time given the recent rally that we've seen. With that, we start with the show. The first theme is basically the rural agri theme because we've seen counters like UPL, the fertilizer stocks, couple of the tractor stocks, and a lot of these two-wheeler stocks started to move. Given the fact that the Congress has said that they will go in for a farm loan waiver in the 3 states that they've won. The PM himself, as per media reports, has indicated a close to a 4 lakh crore farm loan waiver. What does this mean for the agri theme or the rural theme, and which are the key stocks that you need to play with this? We'll ask again. So, Savi, I'll start with you. It's a known fact that there could be something, a lot of populist measures will now come in as reported by the media. Given that the BJP will now try to go in after the rural votes. If someone has to play a theme stock-wise, which stock would you say?
So we hold Hero MotoCorp, and I think that's a good way to play the rural theme without the, the regulated sectors of fertilizers, etc., which we are kind of averse to investing in. So, Hero derives more than 50% of its volumes from the rural sector, and they have a significant market share, more than 50% market share in the entry-level motorcycle. And for the past few years, the volumes have been tepid, and and because of that, the stock has also not done that well. Overall, it's a big beneficiary of the entire pickup in rural, sentiment, and as penetration increases and we reach the level of penetrations in countries like Indonesia, etc., I think Hero has a long way to go, and the stock is trading at less than, I think, 16-17 times 1 year forward trailing, 1 year forward earnings, and with a business which makes more than 35-40% ROE. So I think that's one stock that we like.
Okay, given the fact that Bajaj spoke about pricing and they will go in for pricing rather than market share, couple of launches coming in across the board, tie-ups with foreign company. Do you think that Hero will be able to? How does Hero fit into this entire scheme of things among the two-wheeler space?
So basically, what we have seen is that every player has their own niche which they operate in, and the other players try and break that niche. So be it Honda in the scooter segment, or Bajaj in the slightly premium motorcycle, and Hero in the entry level, or Eicher in the premium segment. And no one has really been able to break that monopoly or kind of quasi-monopoly that each of these players have. They have been able to protect their turfs, and they have also, all of them have tried to break into each other's turf. So in that sense, Bajaj, just that pricing thing, it does not play out. It has played out over the last couple of months. If you see, the volumes of Hero have suffered as compared to a TVS or a Bajaj. But we believe that is transitory, and the strength that they have in their core segment, that is not going to go anywhere. We are not really pricing in a lot of growth in their other segments, which is exports and premium that they are trying to play. We are assuming that they'll have limited success there. But the core segment, which is the entry-level motorcycle, I don't think anyone can compete with Hero on that. So.
Okay, that's the point. So Hero is the first stock. Foram, which stock are you all investing, telling your investors to bet on as far as the rural agri theme is concerned, considering what all has happened?
Yeah, so we feel that FMCG would be the first sector which would benefit out of it. So as the loan waves of the disposable income in the hands of the farmers increases, and the first thing that they would want to go and buy is the necessity products. So FMCG stands tall in these kind of products. If you look at their pricing way also, they design prices to cater to the rural area. So we feel that out of the FMCG sector, the top bet would be HUL and Britannia, because we just saw of late HUL acquiring Horlicks of GlaxoSmith, and which is like a huge positive. the brand also, the Horlicks brand is also very well known in the rural area, and so we feel that once it comes in the segment of HUL, the food and refreshment segment, which I think has 10 to 15% of the total revenues, would be increasing at a good 20-30% growth rate. So I think it would then become to 18% of the total revenues. And overall also, if you see the volume growth in the HUL, it's doing quite good. It's at 10, in double digits only. So with this acquisition also, we feel that it would augur to the top line. As a result, this is like a must buy. And now that the valuations are also comfortable, though HUL is trading at 52-week high, but still, this news is very positive, and it can give a more boost to the top line. So HUL would be the top pick. Then again, Britannia is something that we have now started recommending. We were a little cautious on the valuation side of the Britannia, but now that of course we have a farm loan waiver, so we don't think so this can be a miss at current market price. Britannia is also coming out with various new launches, and obviously it has a very stable performance. It's growing at a good CAGR of 20%, and it's maintaining its CAGR, which is very important. So I think FMCG sector is something that we should not miss at current juncture, and that is why we recommend HUL and Britannia.
Okay, Hero MotoCorp, HUL, Britannia. What about you, Komal? Which are the stocks?
Correct. Government, based on the farm loan waiver or the other initiative that are taken by the government like MSP, we also would like to recommend a FMCG and two-wheeler segment to the client. The reason being, let's say if we look at the FMCG sector, where the 40% of the demand comes from the rural segment, this kind of an initiative will help them to boost their revenue growth. We'll recommend Dabur or HUL again in this segment, because most of their 40 to 45% of their revenue comes from the rural segment. So more disposable income in the hands of the farmer will also help them to grow the revenues of this company. Two-wheeler again, because of the more disposable income in the hands of the farmer, we will see a double-digit growth in the volumes of these companies. So two-wheeler and
in two-wheeler, which is the topic that you all are recommending?
TVS Motors is what we will recommend.
And you're not concerned about the valuation of TVS, because that's pretty steep compared to a Hero or a Bajaj.
Correct. So see, the FMCG or two-wheelers segment are definitely trading at a premium, but during this volatile market, this kind of a stocks will help the customers to get that stability in their portfolio.
Okay, so that's the view that's coming in. The rural agri plays, basically consensus view across the guest is that FMCG or basically the auto, especially the two-wheeler space. So counters that we spoke about right now include a Hero MotoCorp as well as a TVS Motors, and in the FMCG space, it's basically HUL, Britannia as well as Dabur. So that's the first theme that we spoke about. Again, markets are moving now, and people want ideas. What are good stocks that you want to recommend? So we've kept it open, a large cap or a mid cap stock that our clients, our guests are recommending their clients to invest in. So Foram, I'll start with you. Which is the stock that among the large cap or mid cap that you're telling your clients now is the time you should start investing?
Yeah, so we feel that Maruti from the large cap space, is something that you should buy at current market price. Market has given such attractive, good healthy correction, and all the large caps are trading at very attractive valuations. So we thought that first we should skew towards large cap, then mid caps. And amongst the large cap, we feel that Maruti at current market price is a very good buy. Of course, it has a higher base, and that is why volume growth would get impacted. But then if we look at the passenger vehicle segment, it still remains a market leader in the passenger vehicle. The market share is growing, but not at a high rate. It's growing marginally, but more than 55% of the market share is from the passenger vehicle lies with Maruti. So we feel that Maruti, now the fact that it's corrected from some 9,000, 10,000 levels currently, so this is like a good buy. And of course we have inflation numbers. We just saw yesterday the inflation numbers, and IIP is good. Inflation is cooling down. We are expecting a rate cut, if not in the next bi-monthly policy, maybe the later. So once rate cut starts happening on the cards, we will again see pickup in the automobile sector. And again, Maruti is something that we should not miss. So a lot of positive factors are there: rural income growth, rate cuts, and good introduction of new vehicles also. I mean, we have just seen that they have launched couple of two SUVs also, and they have also come out with a press release saying that even the CNG cars are doing quite good. So I feel that the compact car demand, which was hampered in the last automobile sales numbers, if we dissect the numbers, the compact cars did not do good. So the demand in the compact car segment would come back once the rural income starts picking up. So we feel that Maruti at this price, at this valuation, is a must buy.
Okay, what about you, Komal? Which are
We'll recommend Escorts to our investors. It has seen a significant growth in last 5 years. If you see their efforts like entering into south and west region or improving their network of distribution, new innovative products and newer technology, this all has helped them to grow at the rate of the profit growth has increased at the rate of 38% in last 5 years. Again, their agri machinery, or you see the consumer construction the part, or the railway segment is growing at the constant rate of 12%. So this gives them an advantage, and we see that the tractor segment, especially the tractor segment, will grow at a faster rate, and they will increase the market share in coming few years. During the festive season also, we have seen a very good demand in the tractor segment. So we will recommend Escorts to our clients.
Is it a better pick than M&M?
Yes, because as I explained, they are trying to enter the new market. Again, the new venture that they have done, this all gives a positive for the clients.
Okay, and what about you, Savi? Which stock, mid cap, large cap that you are recommending to your clients now?
So we have been we have had DCB Bank in our portfolio for a very long period of time, and the stock has not it's been range bound and not done anything for the last 1 year or 2 years. But this is a company we are very bullish on. We've been tracking the company for many years. So the new management which came in 2009, they have done a remarkable job in terms of first getting rid of the legacy unsecured businesses, writing off the losses, and then and after that getting into the path of profitability, and after that getting into an aggressive expansion plan which involved doubling the branch count in the last 3 years. So that has obviously resulted in a significant increase in cost to income ratio. ROEs have dipped, and they have now they're close to low double digit or close to 10-11%. But that expansion program ended a couple of quarters back, and we see the cost to income declining significantly over the next few quarters, and ROEs inching towards 14-15% in the next couple of years. So that we believe will lead to some kind of re-rating in the stock. It is currently trading at 1.6 times trailing price to book, which is, we believe, in our view, very attractive. They are very conservative on the lending side, very small loans, not present in corporate lending, don't have any stressed assets in terms of S4A or 525 or those exotic ways of hiding the understating the NPS. So therefore we believe it's a good stock with a limited downside.
On this forum itself, you all have spoken about DCB Bank, but it's been a marked underperform. It hasn't performed. Any reason what seems to be the concern that the street has, that despite several private sector banks moving, this one hasn't?
Yeah, so the ROEs, like I said, were going down, and they till now they have been the upward trajectory has not happened. If you look at the guidance that they gave in 2013, which was just before they went into this expansion spree, they guided for a 14% ROE in the quarter ending FY19. So the street believes that probably will be difficult to achieve. Even in our opinion, maybe that may not be achieved. But we believe that maybe 1 or 2 quarters from there on, we can meet those numbers. The street, I think, is very skeptical of whether the bank will be able to meet those numbers, because it will actually mean a significant operating leverage and a significant decline in cost to income to reach those 14% kind of levels.
Okay, so that's the view that's coming in from our guest counters like Maruti, Escorts, as well as DCB Bank are spoken about. Now, the other thing that people want to now know is the worst over for NBFCs, because we've seen these bear market rallies in the NBFC space where again, they've dropped significantly. There's a move, and again they start to correct. But is the worst over? Like one of the prime lending bank always says the worst is over, but somehow that never comes in. We're asking our guest, is the worst actually over for the NBFC space? Komal, you think worst over?
So see, if you see in last 5 years, any third multi-bagger you pick up, it will be from the NBFC sector. But after IL&FS issue and the liquidity crunch that we have seen, increasing defaults have increased their provisioning cost. At the same time, interest rate also acted as a dampener to their profitability. So the worst is not over. According to me, there will be some more pain in this sector. One needs to be very cautious when they are picking up a NBFC, because most of the NBFCs are corrected by 10 to 15 to 20% also. But that does not mean that we go and buy it, because if you see from the valuation perspective, in last 5 years as they were growing at a faster rate, we have given a very high valuation to those companies. So just correcting by 15 to 20% don't make them attractive. So
you still believe they are expensive?
So most of the NBFCs are still expensive. If you take away the housing finance company, they have corrected significantly. But still, Bajaj Finance is trading as compared to the other peers at a higher valuation.
So what are you recommending your clients in the NBFC space? If a bit of their portfolio allocation has to happen towards NBFC, which are the ones that you believe are fairly valued?
We'll not say, because see, again, as I said, one needs to be in the NBFCs which have a stable asset quality, at the same time have more promoters equity in their company. So we'll recommend Bajaj Finance, HDFC, Muthoot Finance to our clients from NBFC, and avoid NBFCs which don't have a good track record or has a corporate governance issue, or don't have the skin in the game. So we'll avoid those kind of companies and would recommend a larger NBFCs like HDFC or Bajaj Finance.
Okay, Foram, you must be getting this query a lot, whether you should invest in NBFCs at this point of time. What are you telling your clients, and if yes, so which are the stocks that you believe which are the stocks that you're recommending to your clients to accumulate?
Yeah, so we feel that NBFC, you can definitely accumulate at current juncture, because we have seen very healthy correction in NBFC space. And of course, not all the NBFC stocks should be painted with the same brush. So there are very good quality stocks like the large caps, Bajaj Finance, HDFC. Undoubtedly, they are very good, good corporate governance, healthy growth rate in their books and everything. But also now we feel that, the broader scenario has changed now. We do not see rate hikes happening in the near term. Of course, because crude has stabilized, inflation is it's under control, and we also saw that in this last bi-monthly policy, SDR being cut, and there's target to come down SDR to 18%. So which is very healthy, and RBI is taking steps to infuse liquidity. So in this scenario where we know liquidity is going to be infused into the system, we don't see there would be any ALM mismatch. We do not see NIMs getting impacted. As a result, we feel that NBFCs, good NBFCs which got hampered because of the entire sector, can definitely be bought at current levels.
Like which ones?
Yeah, so we feel from the mid-cap space, L&T Finance is something that you can definitely buy at current levels. It has a good corporate governance. If you look at their disbursements, it's growing at good, more than 30% upside. The loan book size is also very good. The CEO, the CMDs, Mr. Dinanath Dubashi's view was there to give return on equity to the shareholders of 18%, and he is very much walking the talk. Every quarter on quarter we see ROEs increasing. Its NPAs have come down drastically from whatever that 4%, NNPAs to now some 2%, and it's going to come down also. The management has taken conscious steps to cut down on their loss-making businesses and infuse capital in the segment which is getting more traction from the rural side. And of course, when we see rural income picking up, and of course we have an election here, so we will see expenditure from the government also being infused into the system. So all these things augurs very well for the NBFC space also. So we feel that whatever overhang was there from the macro side, seems to be easing out, and with valuations being justified at current levels, we feel L&T Finance is a must buy.
Okay, L&T Finance, you had counters like Bajaj Finance and HDFC that's been spoken about. Savi, I think you all were rather bullish on the gold loan space. You all still believe, and overall, what's your view on the NBFC space? Are you all seeing the rally continue, or are you concerned now?
Yeah, so we, when at the peak of the rally, we came out with our quarterly investor update where we basically talked about, how you cannot paint the entire NBFC sector with the same brush. And we have seen far worse liquidity crisis in 2013 during that currency crisis and in 2008. And the NBFCs came out stronger and within just a few months or a couple of quarters. So this was a far lesser crisis and I think the market overreacted. But we do see some pain in some pockets of NBFC. So we are avoiding spaces like commercial lending NBFCs like say, the likes of IIFL, Edelweiss, Piramal, these people who lend to real estate developers because the end market is in pain. One, there is demand issue and there is obviously also a asset quality issue. So that is something that we've, on top of that there was a significant ALM mismatch because these guys were borrowing from short-term markets and lending for very long-term projects. We have been very bullish on spaces which are retail oriented, but retail oriented where there is pricing power. So where if there is a 2% increase in cost of funding, they can easily pass on that to the end consumer, and that happens to be spaces like SME, gold finance, microfinance, where you're lending at 24-25%. So even if you increase the lending rate by 100 bips or 200 bips on an incremental basis, does not make a huge difference to the person's life. In contrast, if you look at something like a housing finance, when you have even a 100% increase in your cost of borrowing, and when you pass that on to a customer who is borrowing for 15-20 years at a cost which is say 11% or 10% as compared to what was 9% earlier or 10% earlier, there will be some kind of a postponement in the consumption of the loan. They'll probably not take that loan, and that is what we are seeing in the housing finance space. So I would avoid, we would avoid these spaces like commercial lending NBFCs and housing finance NBFCs. Barring that, we like these spaces that I talked about. We still like them. The prices are still very attractive. All of them are still trading at around less than 2 times price to book or slightly more than two times price to book. So yeah.
Okay, that's the view that's coming in on the NBFC space. And since the markets are heating up, obviously some of the stocks have gone up and are pretty much still overvalued. We're asking one stock which probably, if it's in the F&O space, you can short it, or pretty much an avoid from your side. So Savi, I'll start with you. Which is the top avoid as per you at this point of time?
So I had spoken about this earlier as well. This is Z, and when I had spoken about it a few months back, at that point the entire divestment of stake was not planned, but now that is additional information that we have. See that it means 2 or 3 things in my opinion. One is obviously there is pain at the promoter level where they are having liquidity concerns, and there is an urgent need to divest this one asset which is worth a lot of value as compared to a lot of the infra assets that they have and that they need to fund. So that is one problem. And second is obviously the problem of the industry, which is, we believe, very structural in nature, where the entire data boom, OTT boom, all of these Netflix, Amazon Prime, and all of these, even the traditional broadcasters coming out with their online platform, all of that will mean a lot of pressure on the existing traditional businesses of broadcasters like Z. So that we believe will lead to a significant pain in their core revenues, which is subscription and advertising, because advertising is also moving to digital in a very significant way. So that and that being said, the stock is not really it's very expensive, and we believe this is one stock that that we would avoid. The only upside risk here is that a large strategic player buys it for a significant premium. Likelihood of that is difficult to say. We can't think of any players where it actually makes a strategic fit, but you never know. Someone can come down and pay top dollars for the asset, so that's a risk there.
Okay, so that's the way on Z. Apart from it, Foram, what are you all telling your clients to avoid?
So we feel that telecom sector could be avoided at current juncture because as I said, market has given very healthy correction, and we do not see a need to go and run and buy, telecom stocks. So of course, telecom stocks all fell and they're not running for a reason. The reason is of course Reliance Jio, which is giving them huge competition, and it is doing very well, in terms of subscribers and all. So we feel that, all these domestic telecom companies would have to do lot of activities like acquisitions and merging up, and we did see in Vodafone Idea case. So we feel that there would be, and these are all capex intensive sectors. We are on the verge of getting 5G spectrums, and also that would again lead to a huge capex for these companies. And of course, there is a tariff war, so which does not fetch them good top line also. So we feel that at this current juncture, where so many stocks and sectors are available at attractive valuations, there is absolutely no need and to have telecom sectors in your portfolio.
Okay, what about you, Komal?
Here also we will take a basket approach where we will avoid PSU stocks specifically. The reason being the issues that they have related to NPAs. Again, the consolidation is happening in the sector, so most of the bandwidth of the management is going towards consolidation efforts rather than focusing on the margins or profit of the company. So we'll avoid that particular PSU bank segment. The private sector banks are expected to do better than their counterparts PSU bank. At the same time, private banks market share is also increasing because of the pain in the NBFC and PSU sectors. So we'll rather we are overweight on private sector banks as compared to PSU banks. So we'll avoid PSU banks as well.
Okay, so that's the view that's coming in on sectors or stocks that should be avoided at this point in time. But with that, we're completely timed out on this edition of Hot Money. Savi, thank you so much for coming in. Foram, Komal, thank you so much for coming in today through the studio for the show. Ask BQ comes up next. Stay tuned to Bloomberg Quint.